In this question, X and Y share profits in the ratio of 5:3. And the last line is prepare journal entries, necessary accounts and new balance sheet, also calculate new profit sharing ratio. Here working notes. Old ratio of X is to Y is equal to 5:3. Z is admitted for 1/8 share. X's new share is equal to 5/8 minus 1/8. The important word, this is 4/8. As Z acquires his share entirely from X, and this is one of the important point. Z acquires his share entirely from X, so hence X is only sacrificing. Y's new share is equal to 3/8. Z's new share is equal to 1/8. Therefore, the new ratio of X is to Y is to Z is equal to 4:3:1. Sacrificing ratio is equal to old ratio minus new ratio. Excess sacrifice is equal to 5/8 minus 4/8. That is equal to LCM 8. 5 minus 4 is equal to 1/8. Y's sacrifice is equal to 3/8 minus 3/8. That is equal to 3 minus 3/8 is equal to 0/8. Therefore, the sacrificing ratio of X is to Y is equal to 1:0. Fair notes, revaluation account, debit credit with a particular rupee symbol. Now, the basic theme is that it is to provident fund, A part. Employees provident fund liability is to be increased by 5,000. It is 5,800. It is 10,000. It will be 15,000. Increased by. Increase in liability is an expenditure for the firm. Hence it is debited to revaluation account. Next one is debtors. All debtors are good. Therefore no provision is required on debtors. Hence, reserve for doubtful debts or provision for doubtful debts will be in the credit side for rupees 600. It is better to write down provision as it is written in the question. This is decrease in liability, income for the firm, credited to revaluation account. Next one is stock included 3,000 for obsolete items. To stock, increase in stock 3,000 for obsolete item, increase in obsolescence. That means stock is increased. Stock obsolescence items increased. That means stock is decreased. Obsolescence items means the items written off, thrown away. To stock 3,000. Decrease in asset is an expenditure. Obsolescence is an expenditure just like depreciation. Creditors are to be paid 1,000 more. Increase in liability. To creditors. Increase in expenses. Lost the firm. Fixed assets to be revalued at 70,000. Previously fixed assets are 80,000. Hence depreciation in fixed asset is to fixed asset 10,000. Then revaluation is over. We have to total the debit side. That is rupees 19,000. Take it to the credit side and find out the gap. This is by capital accounts revaluation loss transferred in old ratio of X is to Y, that is equal to 5:3. And the difference is 18,400. That is equal to X is equal to 18,400 multiplied by 5/8 and multiplied by 3/8. That is equal to rupees 11,500 for X, for Y rupees 6,900. Then your capital accounts, after drawing the proper capital accounts, it is by balance brought down rupees 70,000 for X and rupees 31,000 for Y. Then by workman compensation reserve, there is no workman compensation liability. Entire reserve will be distributed as profit. That is by workman's compensation fund or reserve, that is 3,625 and 2,175 in old ratio 5:3. Then by cash account, he has to bring in 20,000 as his capital and 12,000 as a premium for goodwill. By cash account, 20,000 for capital, fine. cash account debited to Z's capital account, and for goodwill 12,000 which is entirely payable to Z. Hence by premium for goodwill, X will be getting 12,000 and it will be brought in by Z. Z paid for goodwill 12,000 which is only to be taken by the sacrificing partner. Hence it was credited to X capital account. This is like premium for goodwill account debited to X capital account. Then your workman's compensation reserve, that is already distributed. I have already explained this. Then revaluation loss in the debit side to profit and loss account is appearing in the balance sheet's asset side 2400. This is an accumulated loss or a last year's loss, as the case may be. Now it will be distributed among old partners in old ratio. X's capital account debited, Y's capital account debited to profit and loss account. That is to profit and loss account in the old ratio of 5:3. That is 1500 and 900. And revaluation loss then to revaluation account 11,500 for X and 6,900 rupees for Y. Now total the credit side, take it to the debit side. The totalings are for X rupees 85,625, for Y 33,175, for Z rupees 20,000. Then two balance carried down. That is difference of capital of X, Y, Z. That is rupees 72,625 and rupees 25,375, and for Z rupees 20,000. Then your balance sheet, draw the balance sheet as at 1st April 2017, and the differences, that is we have to start from the asset side. That is first one is land and building rupees 5,000, as the land and building is to appear in the same value as given in the book. And the next one is sundry debtors 20,000, and the debtors are all good, hence no provision will be there. Stock is rupees 22,000, and as the stock is already appearing in the books at 25,000, the decrease in the value of stock is by 3,000 due to obsolete items. And next one is your fixed asset revalued value or new value, and the next one will be cash rupees 32,000, as the new partner is bringing in 20,000 as capital and 12,000 as goodwill. And the liability side of the balance sheet, creditors rupees 16,000. It was 15,000. It is now 1,000 rupees is increased. Creditors are to be paid rupees 1,000 more D part, 16,000. And provident fund is increased by 5,000, that is 15,000. Then capital accounts for X is rupees 72,625 and Y is equal to 25,325, and Z's capital balance is equal to rupees 20,000. All these three amounted to rupees 1,18,000, and the total of the balance sheet both the sides is rupees 1,49,000. Now your journal entries we have to start with the proper format. After the proper format, the first one is cash account debited to Z's capital account on 31st March 2017. It is rupees 32,000 to Z's capital account, 20,000 for capital contribution, and to premium for goodwill account rupees 12,000, being capital and premium for goodwill received in cash from Z. Next one is premium for goodwill account debited rupees 12,000 to excess capital account rupees 12,000, being premium money received and not from new partner transferred to old partner's capital account in sacrificing ratio. It is not received from the new partner transferred to old partner's capital accounts in sacrificing ratio. Here only one partner is sacrificing X. It was transferred to only X's capital account. Next one is profit and loss account appearing in the balance sheet. It is to be written off as it is appearing an asset or loss or debit balance. This is X's capital account debited rupees 1,500, Y's capital account debited rupees 900 to profit and loss account rupees 2400, being profit and loss account written off in old profit sharing ratio among old partners. Then profit and loss account is appearing in the asset side as the debit balance rupees 2400, hence it should be written up to excess capital account debited, wise capital account debited to profit and loss account. Being profit and loss account written off in old profit sharing ratio among old partners. The next one is workmen's compensation fund account debited to excess capital account to wise capital account, because workmen's compensation fund is an undistributed profit now. This reserve kept for meeting the accidental expenses of employees is now not utilized due to no compensation. Hence, this will be credited to partners capital account in the old profit sharing ratio of 3:2, 5:3. That is, being workmen's compensation fund distributed among old partners in old profit sharing ratio. That is 3625 for X and for Y 2175. Now, reserve for doubtful debt account debited to revaluation account, being increase in the value of a provision transferred to revaluation account. Increase in the value of a provision. It is decrease in the value of, not increase, it is decrease in the value of a provision, because reserve is reduced and it is a gain for the firm, hence transfer to credit of this revaluation account. Then revaluation account debited rupees 19,000 to provident fund rupees 5,000, increase in provident fund. To stock, decrease in stock due to obsolescence 3,000. To creditors, because creditors are to be paid 1,000 rupees more. Then to fixed assets account 10,000. Fixed assets to fixed assets account 10,000. This is decrease in fixed assets. Being decrease in the value of assets and increase in the value of liabilities transferred or debited to revaluation account. Then the last entry is loss on revaluation. Excess capital account debited rupees 11,500, wise capital account debited rupees 6,900, to revaluation account rupees 18,600, being loss on revaluation transferred to old partners capital accounts in old ratio, and the totaling is rupees 90,200, the debit column as well as the credit column, and this is the final answer.